Hello, friends. Welcome back to our show, Text Time with Anil Gandhi. I'm your host, Varish. Last week we discussed about HSA health saving accounts. This week we have come up with another very interesting topic, retirement planning, part one, which is 401k plans. Our renowned tax expert, Anil Gandhi, will share knowledge on that today. I will brief about Anil Gandhi expertise. Anil Gandhi is the Forbes 2022 official member with 17 years of experience as finance controller, CFO. He holds senior executive positions. He has worked in Amazon, Starbucks, PwC, Sun Edison. His passion is to help community, business owners, individuals, CFO by increasing their revenue and profits. He has also written so many articles and he has been a guest speaker for many national level events and media channels. So we welcome today our guest, Anil Gandhi. Hello, Anil. Welcome to the show.
Hi, Varish. Hi. Nice to see you here.
Thank you. Thank you for joining us.
Thank you. It's my pleasure.
Yeah, sure. Let's start our show today. So friends, like you retire from the work, but not life. Everyone who works must start planning right from the day one toward retirement, as it will accumulate our sufficient corpus and reduce the burden as we much inch closer to the retirement age. It's prudent to start investing toward retirement in the early stages of life when the financial responsibilities are minimal, as it will reduce the burden of investing later. So having said that, let's start off the today's show about the most talked about and popular means of retirement in the USA. In today's show, Anil will be talking to us about powerful retirement tools of 401k, 401k for the self-employed. So let's start the show.
Sure, Varish. You have put very well about the retirement. Retirement planning is an essential part of financial and tax planning. It plays a key role. So the reason is, whereas our life expectancies have increased substantially, and the Medicare cost, whatever the Medicare we get once we retire from the government, they are not enough to take care of our healthcare expenses. Our healthcare expenses are increased, healthcare costs are increased, but our incomes are not increased when we retire. So it plays a very key role. And it's not only about healthcare. Every person have a different needs and goals, and the planning plays a key role here. So only when you have a proper planning, your dependency of your financial dependency on someone can be reduced. So if you have a proper plan, if you know how much expenses you are going to incur, if you know how much income you are going to earn after your retirement, that is where you will have a better life. So definitely by planning in advance, you can define the path now itself to meet your long-term goals and also needs. So considering this one thing about the retirement, IRS has also came forward and they say that, come on, we want to encourage you on the savings. And if anyone comes forward and do savings, come on, take away some incentive from us through tax savings. So instead of paying to IRS a lot of money, IRS says that keep that money with you if you plan for your retirement. So just to encourage the habit of saving, IRS has come forward. And let's get into the lot more details. What are the retirement options we have? And we'll do deep dive of every element now. Sure. Okay. Let's get into the detailed topic, Varish.
Yes. So please explain us about 401k to our viewers. What is 401k and what exactly is this term for viewers?
Sure, Varish. So as per IRS, 401k is a feature of a qualified profit sharing plan that employees contribute their share from their wages to the individual accounts. And there is a concept of elective salary deference where employees are deferring their tax liability by contributing it, and employer will do some matching for that. And there are also again traditional and Roth. This is a bit complex, but yes, this is what at a very high level, what is a 401k?
So please talk to us in a common words, so more easier for the viewers.
Sure, Varish. I know that it's a bit complex. Let's decode the IRS tax code on this now. So with the 401k, whenever an employer offers 401k to employees, employees have an option to do some contribution. It's not mandatory. Everyone has an option whether they want to contribute or not. So as I was saying earlier, if they want to plan better for their retirement, they can think about from every dollar they earn, if they can put some money for their long-term retirement planning, that is where they're going to save some money in taxes. Instead of paying to IRS, they can use this money for some retirement planning. And 401ks are always employer sponsored. That means the employer has to do some contribution and the employee also has to do some contribution. Whenever there is an employee contribution, I mean, there are different types of plans, but it has to be sponsored by employer.
Okay, nice. So what is employer's contribution to 401k?
Yes, coming to that point. So 401k has an option. One type of 401k it says is if employee, that is if who employees, whenever employee is sponsoring contributing, employer has to contribute or to do matching or at least do some percentage matching. So there's and for suppose most of the plans are designed in such a way that whenever employee contributes 6% of the salary to 401k, employer matches up to 4%. And there are some companies who does 50% of the matching. I have an example, Microsoft. I have few hundreds of clients from Microsoft. Whenever employee contributes $1, the employer who is Microsoft matches 50% of the dollar. So whatever the limits are there, every employee gets a free money from the employer. It's a great tool. It's on top of the salary, employers again pay some money for free. So this is a very great tool to build as part of the building the network for them, network and wealth for employee.
Right. So it's additional dollar which can come to the pocket of employees.
Yep, you are right. It's a free money. We should never lose it. I mean, I have been seeing many employees are not opting in for employer for this 401k. They're missing the dollars on the table. It's just a free money. The employer is coming forward and saying that, come on, you take this money for a free, the matching. So you should never ever miss that free money.
Exactly. And what is solo 401k plan?
Yes, good question. And this is a very common question I get from the public because whenever they see solo 401k, it has different names. Solo 401k, solo K, uni K, self-employed K, one participation K. What does this mean? Whenever you have a self-employed income, and even if you don't have any employees, outside employees, apart from your spouse or part-time employees who are working for less than $1,000 in a year. In those situations, only in those circumstances only, you can open a solo 401k and you are the employer there, you are the employee also there. So you are the only one, there are no outsiders. So there are a lot of benefits under solo 401k. In solo if you are self-employed, this is one of the best plan to choose. So there are a lot of benefits, and let's get into the benefits also.
All right. So are there any contribution limit to 401k?
Yes, Varish. Definitely there are some contribution limits. So there are two annual limits. So there is an employee limit, employer limit. There is an employee limit. There is a specific dollar amount is given by IRS, and it changes from year to year subject to inflation. So compared to the 2021, now this year the numbers have changed. And whatever employee is contributing, it is called different elective salary difference. On top, employer do some matching. It is called employer contribution.
Okay. So are there, what is the contribution limit for employee deferrals?
Yes. So employees can contribute up to $20,500 for this year 2022. Okay. For the previous year, it was $19,500, but as I said, inflation, subject to inflation, it changed. Now up to $20,500, they can elect to contribute to 401k. And if the employee is more than 50 years old, 50 years or above, then there is an additional catch-up, $6,500 they can contribute towards 401k.
So what is the overall contribution limit?
Yes, I know that it's a bit confusing. Employee, employer, employee, employee. Overall, the maximum contribution together is $61,000 for this year, 2022. And for the year last year, it's a $58,000. So employee can contribute $20,500. On top, 25% of the compensation, employer can do the match. So together, it should not exceed $61,000 for this year. But for last year, if still you already have a solo 401k account, and if you have, as an employer, you have an option till now to contribute, but it's a 25% of the compensation or $58,000 the limits. You need to do the calculations, and we can find out what is the maximum amount you can contribute.
Okay, wonderful. That's a good information from your side.
Yes.
Good. I mean, like the question from us could be more in a funny way. You can take it. So, how do you know you are old enough to retire?
Good question, Varish. And many people ask me also about when do I need to retire and everything. But I should say that stop lying about your age. Everyone lies. Most of us lie about their age. Start lying about age and start bragging about it. So if you're having a proper planning for your retirement, start bragging about about what you have achieved already for your retirement. So I should say that it's start bragging rather than lying.
Yeah, I agree with that. Very true.
Yeah.
So moving on to the next question, when can contribution to 401k plan be withdrawn? Will there be any penalties for withdrawals?
Yes, Varish. So IRS allows penalty-free withdrawals only after 59.5 years age only. So if once you contribute, if you take the money out before 59.5 years, you are expected to pay 10% penalty, and you need to pay taxes on that if it is a traditional 401k. So you need to pay taxes and you need to pay 10% if you take the money before 59.5 years. Otherwise, you can take the money after the retirement, that's 59.5 years. There is no penalty, but you need to pay taxes on that. And you have an option. There is no mandatory that you have to take the money immediately after 59.5 years. But after you cross 72 years, there is a concept called required minimum distributions, or it's also called as RMD. It means you have to take out some money from your retirement account. And whenever you take the money out, you have to pay taxes to IRS. And unless it is a Roth 401k, you have to pay taxes on this RMD also.
So if anyone changes the job, then in that case, he can still withdraw with the penalties, or what?
There is some concept called hardship withdrawals. So IRS says that you can withdraw money before even 15.5 years without any penalty, provided there is some hard conditions. We have bigger problems, like you may have a very major medical expenses, or you have some family issues where you have to pay some rent, mortgage, pay, or any major unusual conditions for you where it's difficult to survive your life. It is called hardship withdrawals. In that circumstances, you can take the money out. But my request to everyone is don't withdraw money from 401k to the extent possible, because if you are taking out your 401k money now, you will struggle in the retirement when you retire. You may be very young now. You may be thinking 60, 65 years, 70 years, we can think about at that time. No, everyone will retire. Even though you are at 20 years now, don't forget that you are going to retire at some point of time. No one can stop retiring. No one can stop dying. So those are mandatory in our life. It will happen. So when you know that definitely it is going to happen, why can't you start planning? Plan for that. Start doing it. Government is also saying that, come on, you are doing a good job, take these incentives. So sit with your financial advisor and start planning for your retirement.
Correct. Very true. So what are the next benefits of contributing to 401k?
Yes. as saying that IRS always come forward, say that, come on, you do this retirement, we are there for you. So whatever retirement contributions you are doing for your 401k, and if it's a traditional account, it is a pre-tax. It means, I want to give an example here. So assume you are saving, you are earning $100,000 in a year. You can contribute up to $20,500 towards your 401k account this year as employee contribution. You are going to save taxes on this $20,500 because this is a pre-tax. It means on the balance $79,500 only you are going to do calculation of taxes and pay to the IRS. The $20,500 is a free money for you. You don't need to pay any taxes, provided you are saving this money for your retirement. And also, as long as you are investing and as long as you are not touching your 401k account balance, you go and invest this money in any stock market or any other long-term mutual funds or stock market or bonds, wherever you want to use, invest. And if you make any money on that, like interest income, dividend income, or any capital gains on this sale of your stock market, your shares in the 401k account, you are not going to pay any taxes on that in this year. And it gets accumulated. You will be paying taxes only after your retirement, only when you take the money out. Otherwise, you don't need to pay any taxes for now. So these are the tax benefits perspective. These are the tax benefits we have.
Right. Yeah, as always with the IRS. So what is it?
Yes. So as I was saying that you have to, the IRS has mandated that you have to take the money after you attain 72 years. Like some people tell me, I have a lot of doctors, physicians, practitioners as my clients who are already retired. They don't want to touch their money, retirement account, 401k. So if you don't take the money out, who will pay the taxes to IRS? So IRS says is you have to take some money from the retirement once you attain 72 years of age. And whenever at that time, whatever tax bracket you are, at that tax rate, you need to pay taxes to IRS. So you are going to pay taxes at the prevailing rates when you take the money out, not on the current rates. It will be in the future rates.
Okay, nice. So just a minor detour, as you mentioned, required minimum distribution twice. So what are they?
Okay, so it's a good question. Many of the viewers might not be aware of what is an RMD. So RMD is like a minimum amount you have to take out from your retirement account every year once you touch 72 years. You may think that, no, I have a rental income or my kids are taking care of me. I don't need to touch my 401k account. No, IRS don't allow that. You have to take some money from your retirement account. There are some different calculations out there. Considering the shortage of the time, I'm not getting into that how you calculate RMD, but you have to take some money out from your retirement account every year and pay taxes to IRS.
Okay. Referring to the exception, you mentioned in the beginning that depending on type of 401k plan, you get a tax break either when you contribute or when you withdraw money for retirement. Is that what it is about?
Exactly, Varish. You are a smart guy, Varish. That's what exactly we're talking about, tax planning. That comes under tax planning. Okay. So the other plan, what I was referring earlier, is nothing but Roth 401k. You always have an option. Most of the employers always give an option to select traditional or Roth. I want to give it very high level. What is the difference between traditional and Roth? Traditional is the regular 401k where everyone is aware of. You contribute, you enjoy the tax benefits, but in the future, whenever you take the money out, you need to pay taxes. But Roth works in a different way. So Roth is, you don't enjoy any tax benefits now, but you go to enjoy the tax benefits forever in your lifetime. It is like, because once you contribute to the Roth account, no tax reductions for you, but this money can be invested in the stock market, mutual funds, or you wherever it allows. If it grows also, the money grows, we get earnings, dividends, interest, capital gains. You don't need to pay taxes forever in your lifetime. And you owe to IRS. So it's you don't owe to IRS anything, even though you take the money out from your 401k in the future because the taxes were already paid when you contribute. So,
okay. So, but why is that so?
yes. Okay. Why? It's a good question. Why IRS is not taking taxes when you take the money out at the time of retirement? Because this is a Roth. IRS can take only money taxes only one time, either at the entrance or at the exit. So at the entrance, for the traditional at the entrance, they give the tax benefits, but they catch you at the exit. But for the Roth, at the entrance, they collect the ticket from you, that tax from you. But when you exit from the 401k account, when you take the money out, you don't need to pay any taxes. So it's only IRS wants to take the taxes only at one time, either seed or harvest. Pay it one time at least, either here or there.
Right. Makes sense.
Yeah.
So what are the qualified withdrawals?
Yes. So I discussed this at very high level. The qualified withdrawals are where IRS allow you to take the money. That is, after 15.5 years, you can take the money out. It is called qualified withdrawals. Whenever you are doing a qualified withdrawals, you don't need to pay any penalties. It can be qualified withdrawals, or even it is a hardship withdrawals. In those circumstances, you don't need to pay any penalty.
So coming to solo 401k topic, how can solo 401k account can be opened?
Yes, as you're saying that if you are a self-employed, if you don't have an employees, solo 401k is one of the best option to open, to contribute, because you can contribute up to $61,000. When can you open this account? Where can you open this? Most of all online stock brokerage account brokers will allow you to open a solo 401k account. It can be Vanguard, Fidelity, or TD Ameritrade. There are so many online accounts out there. All the service providers, wherever you open your account for stock brokerage. And once you set up the account, you can even set up the auto payments every month to match or your $20,500 contribution or $61,000 contribution. You can do the auto setup payments, or you can every month it takes the money from your bank account as a contribution. And once you invest the money, once you deposit the money in your solo 401k account, you can go and invest in stock market, indexed funds, mutual funds, exchange traded funds, or individual stocks, or in also. So just like a regular 401k. So there are a lot of options. It's a great tax saving tool, and also it's a great retirement planning tool.
Wonderful. So are there any contribution deadlines to solo 401k plan?
Yes, Varish. Solo 401k before December 31st of any year. Like example, for the 2021, you cannot open it now. But for the 2022, you can open this account before December 31st, 2022. And there is a contribution deadlines also. As I said, that employee and employee deadline is December 31st, 2022, and employer has more time to contribute till they file their tax returns before filing a tax filing deadline, which is April 15th. So,
sure. One more question that is in my mind. Let's say, like, if anyone is deceased, anyone die, so what happens to their family? Like, do they get the 401k account balances, or what is that strategy?
Yes, it's a very good point. And during many unfortunate situations we always see, even in the last COVID time, last couple of years, we have seen so many deaths. So, and what happens all of a sudden, something happens. It goes to the legal heir. Then the legal heir has to pay taxes on that. Yes, it will go as per the will and trust, whatever you have written. So it will go automatically. And also when you open a 401k account, you also mention beneficiary. Whoever is the beneficiary, money goes to them, but they need to pay taxes on the money, whatever there is.
Wonderful. That's a good information for our viewers. So as always, like, we have a very informative session, Anil. Let's wrap it up, and on the last notes from you on the retirement planning. So please suggest something as ending notes.
Thanks, Parish. And as I was saying that retirement planning is very, very important, because that will help you to have a peaceful and joyful time after you retire. You might have seen so many cases when after retirement, people will struggle so much for the money, because the money, whatever they get, maybe from the social security income, that is not enough to take care of their expenses. They are depending on the next generation, or they maybe have very big health bills, medical bills, or you want to go somewhere, you are dependent. So, but if you can do a proactive tax planning, come on, proactive retirement planning, come on. So that is where you are going to have a better life. So when do you need to start planning? You are already 30, 40 years and you are worrying now. Late is better than never. At least start planning now. Yes, I agree that it is great if you start retirement planning at the age of 20, but it's okay you have not done. At least realize now, open your eyes now, start planning from now, and start saving every dollar into your retirement planning now. And there is a lot of tools. And apart from this 401k, whatever we discussed today, we do also have one more great tool. It's called IRA, Individual Retirement Account. But in our next live show, we will talk about IRA accounts. But until then, signing off. Thank you very much, Varish.
Thank you, Anil, for joining us today and giving us valuable tips. I will also start thinking about 401k more sharply, and our viewers will too also. Thank you.
Thank you, Varish.
So friends, we have come to the end of this impactful episode. We will be meeting again next week with another episode with our expert Anil Gandhi. So till then, stay tuned. Bye for now and take care. Bye.